think that the stock market has this notion that we're going to have deregulation, we're going to have corporate tax cuts, and that's going to boost corporate profit margins. And I think that's probably a fair part of the argument. But I think what they're missing is all the consequences of the other parts of the Trump agenda. Higher tariffs mean higher inflation. They mean disruption, lower productivity growth. Deportations affect the supply of labor. And unsustainable fiscal path means higher interest rates. When I look at the bond market versus the stock market, I think the bond market, as bond yields rise, that's going to put increasing pressure on the stock market. We're starting from a point that the stock market valuations are already extremely high. So if bond yields go up, I think that will weigh on the stock market. I would not be a big stock market bull at this point.
Bill, given that backdrop, how difficult is this December meeting going to be for the Fed?
I don't think it's going to be that difficult because I think Powell laid it out pretty clearly last week. They think that the economy is the risks of inflation and the labor market are roughly in balance. They think monetary policy is still restrictive, so that they're heading back towards neutral slowly. So I think a 25 basis point rate cut in December is still the most likely case. Now, if the economy continues to stay stronger than expected and inflation stays stickier than expected, then that December rate cut might be the last rate cut for a while. But that really depends on the data. The Fed right now is really data dependent in terms of where they're going. The direction of rates is downward, but slowly because the economy is continuing to perform pretty well on the growth side.